Do you know there are 8 publicly listed banks in Malaysia, and most of them make a great starter's choice for investors? I mean, instead of just putting your money in the bank to earn fixed deposits interest, what if you could actually own the bank itself to earn dividends from it? And that's why Malaysian banks are always a favorite in many investors' portfolio. They offer share price stability and dividend consistency that's hard to find elsewhere. But here's the thing, not all the banks are the same. Each has its own characteristics ranging from their business models, target markets, dividend policies, etc., which will suit investors of different goals and risk appetite. But fret not, we're gonna dive deep into all of them today, and trust me when I say this, your time spent here will be well worth it. But before that, if you're totally new to the stock market, you'll be glad to know that investing in Malaysia stocks can be done easily, safely and affordably with a sponsor of this video, Webull, a Securities Commission Malaysia licensed stockbroker that allows you to invest with zero platform and commission fees for Malaysian stocks until the 31st December 2025. But what is even more exciting is their latest launch called Money Bull, a cash management product that gives all of us 6% per annum interest, and the minimum deposit starts as low as 1 cent and the max is capped at 200,000 ringgit. And not only that, they are currently running a limited time campaign for new users. By just depositing 5,000 ringgit and maintaining in your account for 30 days only, you get 500 ringgit worth of Nvidia shares. And if you want even more free shares, their stock transferring program will give you another 600 ringgit if you transfer 30,000 ringgit worth of stocks from another stockbroker. Links down below for more details, and when you deposit using my exclusive code Z888, you can unlock extra rewards before the campaign ends. You see, banks are the engine of Malaysia's economy. They act as a bridge between people who have extra money, depositors, and people who need money, like for you to buy a house or a car, or even for business owners looking to grow their operations. And when banks do their job well, money flows smoothly, businesses will grow, and it can keep the economy moving. And that's why Bank Negara Malaysia (BNM) pays so much attention to them, because if banks tighten lending too much, it can slow down economic growth. And on the other hand, if they lend too freely, it can overheat the system. Hence why it needs to be balanced at all times. So, how do banks actually make money? Here's a simple example for you. If let's say you deposit 5,000 ringgit into a bank, you earn 2% FD interest per year, roughly about there lah. And then the bank doesn't just let that money sit there, but they lend it out to borrowers who want to buy a car at maybe 4% interest per year. And that difference of the 2% gap is what we call the interest spread. And you can think of it like the bank's profit margin, just like how a business buys at a cheaper price and then sells higher to make profit. And in this case, the product is money. And because banks play such an important role in the economy, acting as the only one who can lend money to businesses and individuals, they are highly supervised by Bank Negara Malaysia, which is basically the banker and advisor to the government. And it is their job to make sure banks follow certain statutory requirements to stay stable, even during tough times. And if you remember back in COVID times, none of Malaysia's banks collapsed or suffered any huge losses, which is exactly why investors call them one of the most stable sectors in the market. But then, as an investor, you need to know that stable doesn't mean guaranteed. Banks will still move with the economy, and when the economy slows down, even dividend payouts can slow down, likewise to your investment returns. So yes, stable but not invincible. But anyways, I've prepared a comparison table for you over here, and these are the 8 banks publicly listed on Bursa Malaysia arranged by market cap, starting with the largest from the left. And like I said earlier, each bank has different target customers, which translates to the different business segment that they focus on, meaning where most of their income actually comes from. And there's 4 main types over here. Universal bank, basically they do it all. Retail and SME bank, mainly covering housing and business loans. Hybrid bank, something like the previous one but with some investment and insurance exposure on its side. And lastly, Islamic retail bank that focuses purely on Sharia compliant financial products. And to find out which one has a good valuation for you to invest in, we can look at 2 key financial ratios: return on equity (ROE) and also the price to book ratio (PB ratio). Both very important metrics when evaluating a bank's performance. ROE basically shows how much a bank generates from its capital, or in other words, how efficiently it uses shareholders' money. Meanwhile, the PB ratio tells you how much investors are willing to pay for each ringgit of their net worth. basically how much the market believes that performance is worth. And here is the trick, you shouldn't just look at ROE or PB separately, they actually move together. Because when a bank's ROE is strong, investors have more confidence and they are more willing to pay for a higher PB ratio for it. So high ROE will lead to high PB ratio. As you can see here, Public Bank leads the pack with the highest ROE and PB ratio, and that's basically the market saying, hey, this bank earns strong returns and we are willing to pay a premium for it. But then you might ask, why do some banks have higher ROE than others? Well, it's not just about their size or their brand name. A lot of it comes down to how clean their loans are, or what we call the NPL ratio, or non-performing loans, which basically measures how much of a bank's loans are not being paid on time. And this is actually a recurring phenomenon, with more loan applications spiking, especially during the festive seasons. Like earlier this year, NST reported that the number of civil servants applying for personal loans had increased by 10%, or 70,000 people in total. And when people overborrow and can't repay back just to show off, they risk facing bankruptcy, hence the NPL or bad debts for the banks. Now, let's take Public Bank again as an example. It consistently has one of the lowest NPL ratios in Malaysia at around 0.5%. And because of that, it doesn't really need to set aside a huge chunk of their profit for these losses. So even without taking big risks, its ROE stays high at around 12%. And this can indicate that Public Bank is a good investment choice, which is also favored by many experts and even investment analysts. But part of what keeps Public Bank strong is also largely thanks to their prudence culture that they have built over decades. That's why even during crises, it rarely overlends or chases risky growth. Now, if you are sharp, you might notice and ask, why does Hong Leong Bank have the same lowest NPL ratio as Public Bank, but it has a lower ROE and lower PB ratio? It is true, both Public Bank and Hong Leong Bank are the top tier in loan quality with almost zero bad loans. However, Public Bank earns higher ROE and trade at a premium PB ratio because it is larger in size with larger loan book and customer base, and because economies of scale, they can then be more efficient in generating income by leveraging on their lower cost and stronger public trust. And Hong Leong Bank is still growing to catch up. It is just smaller in terms of total asset size, running at slightly higher cost levels and reinvesting most of their profit back for more growth. Now, for most Malaysians, the main reason to invest in bank stocks is to get steady and reliable dividend income. Myself included, I was an avid local bank stock investor for a good part of my initial investment journey. So, what exactly is the dividend yield? Well, it is basically how much passive income you receive each year compared to its share price. For example, if a bank pays 50 cents per share per year and the stock price is say 10 ringgit, that is an annualized 5% dividend yield, which is like earning 5% from your investment. And from this table, you can see that Bank Islam is providing the highest dividend yield among all these banks. But here is where most beginners get it wrong. A higher dividend yield doesn't always mean the stock is better per se. Sometimes a yield looks high because the stock price fell, which could mean the markets expect slower earnings ahead. Hence why you still need to cross-check with other metrics to make sure the bank's dividends are backed by real profits, not just short-term payouts. And remember, your total return is a combination of the dividends you receive plus change in the share price, i.e. your capital gains or losses. Now, just a little bonus for you. If you want to diversify your portfolio beyond Malaysia, you can also look at our neighbour, Singapore's top 3 banks, DBS, UOB and OCBC. They are favourites among dividend investors because Singapore is recognised as one of the world's leading financial hubs, right alongside Hong Kong. And these 3 Singapore banks are also listed among the top 15 safest banks in the world, ahead most of their Asia peers. And this shows how Singapore's banking system provides not just a safe place to park your money, but also a stable environment for long-term growth and also capital preservation. Now, before you quickly hit the buy button, just be mindful of a few risks associated with investing with bank stocks. First of all, yes, banks are the safety net of the economy and they are very tightly monitored by Bank Negara. So, because of that, and precisely because of that, its performance will also be dependent on the country's economy. And that's why in downturns, even the safest banks can see their profits dip. Not because management did something wrong, but because banking mirrors the economy. And the key is how fast they recover after the cycle turns. And another key factor is interest rate risk. If say Bank Negara adjusts the OPR or the overnight policy rate based on the economic conditions, it affects both the lending rate and also the deposit rate of banks. Or in other words, this will change how much we as consumers should pay for borrowing loans and also how much we should earn by depositing our money in our savings account. And as a result, their net interest margin (NIM) will be impacted, which eventually affects their net profit that the banks earn. I mean, take Maybank for example. During the first half of year 2020, when COVID-19 pandemic hit, Bank Negara decreased the OPR multiple times to support the economy, and as a result, Maybank's net interest margin compressed significantly as lending rate reflected the changes faster than the deposit rates. And this shows exactly why we should always keep an eye open on the OPR, because changes in the interest rate will ultimately affect a bank's earnings and dividends. And last but not least is credit risk, and this happens when borrowers fail to repay their loans like I've mentioned earlier. And when there are more bad loans, banks must set aside a part of provisions, which then directly reduce their profits and ROE. And that summarizes everything you need to know to get started with bank stocks. So tell me, which bank stocks are you eyeing in Bursa Malaysia? Let's make the comment section down below a discussion room for both beginners and seasoned investors to share their experience. Thanks for watching.